Going on, everybody? What's going on, everybody? Hope everybody is doing well. Hope everybody is doing well. This is the day before Thanksgiving. I hope that everybody is making preparations to be with your families. I'm going to be heading down south to be with my family after this episode is ready. So, like I said again, hope everybody is doing well. Today was the last full trading day of this week. The market will obviously be closed tomorrow for Thanksgiving. And Friday, Black Friday, the market will only be open a half of a day. So the market will only be open a half of a day, I believe, till about 1 o'clock Eastern, 12 o'clock Central. And I also believe the bond market may actually be closed on that Friday. So trading will be very, very, very light. The volume will be very light because, a lot of people will be on vacation. Most people won't be trading. And so you have to take into account the algorithms, right? Algorithms are set by institutions when people aren't actually trading. But understand that news still comes out on the internet that can affect those said algorithms. So keep all those things in mind as we, look towards the end of the year and as we look towards the end of November. And so I don't want to hold everybody's time. I know people want to get back to it. Like I said, I got to get to my family as well. So let's go ahead and get right to it. Again, welcome back to another episode of the Trade for Yourself podcast, where my mission here is still very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure that you please hit that like button. Please hit that like button. Please subscribe. It's going to help me out a lot with this channel, help me out a lot with this podcast to be able to get to more people so everybody can come and get the information that they really truly need to be successful. Now, in this episode, we're going to be looking at the S&P 500, and we're going to see or really answer the question, will the S&P 500 close below 3,500 before the end of this year, or pretty much at the end of this year? Where will the S&P 500 be at the end of this year? And that's a very, very good question. And so we're going to go through some key indicators that I believe are going to move the market, that's going to swing the market to the upside or may swing the market to the downside, depending upon what happens. Okay. And this is going to be very, very important for our understanding to see where we think the market is going to go at the end of this year. Now, I'm not giving any projections for 2023 in this episode. Projections for 2023 will come later on, probably in December, right before Christmas, so we can have some fresh economic data, fresh things that we can see so we can make determinations. But now I want to talk about some things that are going to happen over the next 3 or 4 weeks that you need to pay attention to, because there are going to be some opportunities in this market before this year is out. I know that we've been in a bear market. I know it's been painful, but we're still going to have opportunities ahead before the end of this year. So let's go ahead and share my screen here so we can get this thing started. Now, I know we're talking about where the S&P 500 will be at the end of the year, but I believe, and my argument is that the Fed is going to be a very big determining factor in determining where we will end this year out. Okay. And so let's go through this article, because this article is very, very important. Now, the Fed officials see smaller rate hikes coming soon in the Fed minutes that were shown. Now, the Federal Reserve officials earlier this month agreed that smaller interest rate increases should happen soon as they evaluate the impact policy is having on the economy, meeting minutes released Wednesday indicated. Now, earlier in this month, the Federal Reserve had the FOMC meeting, right? And at that FOMC meeting, they have interest rate decisions, okay? And at that meeting, they have a meeting that the public is not able to be a part of, right? What happens is that they release their interest rate decision, And Jerome Powell comes out, has his press conference, and discusses why the interest rate is the way that it is. Okay. A few weeks after that, the market releases the Fed meeting minutes. So they released the minutes from the last meeting to see what was the consensus, what were the voting members of the Federal Reserve saying during that meeting. And this is pretty much what this article is going to be going through. Now, reflecting statements that multiple officials have made over the past several weeks, the meeting summary pointed to smaller rate hikes coming. Markets widely expect the rate-setting Federal Open Market Committee to step down to a 0.5% percentage point increase in December, following 4 straight 0.75 percentage point rate hikes. Now, the Fed has been raising interest rates by 75 basis points 4 straight times, okay? And those are big interest rate increases. And I will argue that we have not seen the effects of those interest rate increases yet in the economy. And so right now, what the market is pricing in, the market right now is pricing in 0.5 percentage point or 50 basis points in December. What I will tell you is that, number one, if the Fed were to raise interest rates by 75 basis points again in December, that would be a shock to the market, and that would be something that the market is not expecting. And you should expect a big sell-off as a result. Okay, that's really what I want you to understand. But the second thing I want you to understand is, the market may be expecting 0.5 percentage point rate increase for December. But what we need to understand is, where are we going? Like, we know what the Fed has done in the past in this year. The question that we have to answer and what we have to get clarity on is, where is the Fed going at the end of the day? And we're going to get to that throughout this article. Now, though hinting that less severe moves were ahead, officials said they still see few signs of inflation abating. However, some committee members expressed concerns about risk to the financial system should the Fed continue to press forward at the same aggressive pace. A substantial majority of participants judged that a slowing in the pace of increase would likely soon be appropriate, the minute stated. The uncertain lags and magnitudes associated with the effects of monetary policy actions on economic activity and inflation were among the reasons cited regarding why such an assessment was important. The minutes noted that the smaller hikes would give policymakers a chance to evaluate the impact of the succession of rate hikes. The central bank's next interest rate decision is December 14th. More on that later. The summary noted that a few members indicated that slowing the pace of increase could reduce the risk of instability in the financial system. Others said they like to wait to ease up on the pace. Officials said that they see the balance of risk on the economy now skewed to the downside. Now look at this bold text right here. Focus on the end rate, not just the pace. Okay. Markets had been looking for clues about not only what the next rate hike might look like, but also for how far policymakers think they'll have to go next year to make satisfactory progress against inflation. Officials at the meeting said that it was just as important for the public to focus more on how far the Fed will go with rates rather than the pace of further increases in the target range. The minutes noted that the ultimate rate is probably higher than officials had previously thought. At the September meeting, committee members had penciled in a terminal funds rate around 4.6%. Recent statements have indicated the level could exceed 5%. Over the past few weeks, officials have spoken largely in unison about the need to keep up the inflation fight, while also indicated that they can pull back on the level of rate hikes. That means a strong likelihood of a 0.5 percentage point increase in December, but still an uncertain course after that. Now, markets expect a few more rate hikes in 2023, taking the funds rate to around 5%, and then possibly some reductions before next year ends. The post-meeting statement from the FOMC added a sentence that markets interpreted as a signal that the Fed will be doing smaller increases ahead. And remember, every single piece of data that comes out on the tape, the market is always trying to figure out what it means and associate a price with it. That sentence read, in determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Investors saw it as a nod to a reduced intensity of hikes following 4 straight 0.75 percentage point increases that took the Fed's benchmark overnight borrowing rate to a range of 3.75% to 4%, the highest in 14 years. So if we look at it, like they said before, it's not just the fact that the Fed is increasing rates, because we understand that they've been increasing rates all year long. We're trying to figure out, where are they trying to get to? Okay. At the end of the day, every single increase in the Fed funds rate is also going to increase the cost of capital for companies, right? The cost of capital is the amount that's going to cost for companies to borrow money in order to invest into their businesses, right? Companies are not going to be incentivized to invest for growth if the cost of capital is continuing to increase. The Fed funds rate is a big determining factor in terms of looking at what the cost of capital is and what the cost of capital will be. If the Fed funds rate is increasing, that means your mortgage rates will probably be increasing. That means credit card rates will probably be increasing. That means loans on cars and all loans will be increasing, right? The rate that banks charge each other to borrow money from other banks overnight, that rate is continuing to increase. And so this Fed funds rate is very, very important in terms of the cost of capital. Are investors going to be willing to put their money to work, especially if we're raising interest rates, increasing the cost of capital into an economic downturn, into a recession? That is what people are pretty much very wary of. And that's what people are afraid of in terms of talking about potential instability in the financial markets. Now, when will the hikes end? Several Fed officials have said in recent days that they anticipate a likely half-point move in December. They're getting to a point where they don't have to move so quickly. That's helpful since they don't know exactly how much tightening they're going to have to do, said Bill English, a former Fed official now with the Yale School of Management. They emphasize policy works with lag, so it's helpful to be able to go a little bit more slowly. Inflation data lately has been showing some encouraging signs while remaining well above the central bank's 2% official target. Now, the consumer price index CPI in October was up 7.7% from a year ago, the lowest reading since January. However, a measure the Fed follows more closely, the personal consumption expenditures price index, excluding food and energy, showed a 5.1% annual rise in September, up 0.2 percentage points from August and the highest reading since March. Those reports came out after the November Fed meeting. Several officials said they viewed the reports positively, but will need to see more before they consider easing up on policy tightening. The Fed has been the target lately of some criticism that it could be tightening too much. The worry is that policymakers are too focused on backward-looking data and missing signs that inflation is ebbing and growth is slowing. However, English expects the Fed officials to keep their collective foot on the brake until there are clearer signals that prices are falling. He added that the Fed is willing to risk a slowing economy as it pursues its goals. They have risk in both directions of doing too little and doing too much. They've been fairly clear that they view the risk of inflation getting out of the box and the need to do a really big tightening as the biggest risk, he said. It's a hard time to be Fed Chairman Jerome Powell. Now, this article is kind of giving us some guidance, right? Giving us a little bit of guidance to try to see, okay, what do we expect from the market? Okay, what are we expecting for the Fed to do? Now, understand what the Fed is trying to do. Okay, understand that the Fed, again, and I'm glad that we're talking about this because this is something that we always have to keep in mind. We hear a lot about the Fed. We hear a lot about the Fed, but what is the Fed supposed to do? Remember, the Fed has a dual mandate. The Fed has a mandate of having maximum employment and having price stability. Right now, the unemployment rate is very, very low, historically low, I might add, but inflation is historically high. And so the Fed has to do whatever it has to do to get inflation to come down. And so with the unemployment rate being so low, even though it's a lagging indicator, as most people may say, the Fed is saying, hey, the real risk is continuing to allow inflation to be embedded into the economy. Okay. If inflation is continuing to be embedded into the economy, that's going to affect growth over the long term. That's going to affect consumers expecting prices to be higher for longer and them being embedded, right? We can't even bring inflation down a little bit to even bring forth a set of normalcy or pretty much a new balance, because we know prices aren't going to go back down to where they were before the pandemic. But we do need them to stop going up so high at such a high rate. And so when we hear hard landing and soft landing and all this terminology, the soft landing is the Fed being able to raise interest rates high enough without being able to cause a recession. I don't think that's going to happen, because now the Fed is going to raise interest rates higher than what they thought they were, and they may have to keep them there for longer than what they thought. And so what I'm thinking is that the Fed is going to be raising interest rates into a recession, hence not getting a soft landing, more of a hard landing. The employment rate rising, the amount of jobs we're creating for the economy continuing to go down, manufacturing data continuing to go down. I see us going into a recession next year. And so this is kind of telling us like, okay, the Fed has done what the Fed has done. But it's not so much about what they've done already. Yes, we need those interest rate hikes to come through the system so we can have some level of clarity. But at the end of the day, we got to think about, where is the Fed going to go? And so let's pull up investing.com and pull up the inflation, pretty much pull up the economic calendar, okay? And pretty much, what are some things that we need to watch that will determine where we will finish this year? And so I want to talk about some of these things and what these things need to say. And pretty much, depending on whatever way, depending on if they're positive numbers or depending on if they're negative numbers, these things that I'm going to highlight are going to tell us, okay, where do we expect the market to be at the end of the day, right? So remember, what is the main reason why we had the worst first half this year, since 1970? What's the number one reason why we had the worst first half in the stock market? The main reason was inflation, right? And so inflation is going to be another buzzword, right? Maybe not necessarily another buzzword, but it's going to be another topic of conversation. And we need to see, what are the inflation numbers going to be going into the end of the year, right? And so I've got some dates that I want marked off, and there's some things I want you all to pay attention to. The first date that I want you to mark off is November 30th. Let's start with November 30th first. And I don't believe what I'm going to talk about is on this calendar, but this is what I want to tell you about November 30th. We're going to receive a GDP revision, right? And I don't believe that this GDP revision is going to affect the market that much, because the market already has an idea of what GDP is, right? That's not something that I think is going to move the market a lot. But what is going to happen, though, on November 30th, which is 1 week from today, Jerome Powell is going to have a press conference with the Brookings Institution. And so he's going to be talking about the state of the economy. I imagine that whatever he says during that press conference is going to affect the market. And it's even more important to pay attention to what he says, because he's going to be coming back before the market again in 2 weeks, because this press conference that we're talking about, okay, is outside of the FOMC press conference that he has. And so we need to keep that in mind, okay? The second date I want you to mark down is Friday, December 2nd. Okay, what are we getting Friday, December 2nd? We're going to be getting non-farm payrolls. Okay, we're going to be getting non-farm payrolls, and we're going to be getting the unemployment rate. Okay, and we need to look at the forecast and the expectations for that. The expectations is that we added 200,000 jobs in the month of November, and that the unemployment rate will be 3.8%. So notice that the unemployment rate is ticking up and the number of jobs that we have created are coming down. This is what we call like the type of period that we're in right now. We are in a bad news is good news environment. Let me say that again. We are in a bad news is good news environment. What do I mean? The Fed needs to see the economy slowing down. The Fed needs to see the labor market coming back into balance. What does that mean? The employment rate going up, the amount of jobs coming down, the wages, the amount of wages, the hourly earnings, those average hourly earnings coming down. The Fed needs to see that. If the Fed continues to see everything operating well and the economy operating well, that's going to give the Fed more ammunition to tighten. So I'm watching the non-farm payroll numbers and the unemployment rate to see what we are expecting. So look at it like this. If the unemployment rate goes up and the number of jobs created comes down, I believe that will probably be a good thing for the market. I think that the market will anticipate that as a good thing. If the number of jobs increase in November and the unemployment rate actually comes down, that could be a bad thing for the market. And the market may anticipate that as saying, okay, the Fed is going to raise interest rates higher and they're going to keep them there for longer. That's the first thing you need to watch. Okay, second date, December 9th. Okay, I want you to keep an eye on December 9th. Okay, what is happening December 9th? December 9th, we are going to be receiving PPI. Okay, we're going to be receiving PPI year over year. Okay, what is PPI? PPI is the producer price index. Okay, the producer price index measures the price of goods for producers, right? And it's a metric that we are watching in terms of inflation. Okay, again, inflation has been sky high. We need to see that number coming down. Okay, we had a good number. We received a good number. We received a good number earlier this month in terms of inflation, right? In terms of the October inflation, we need to see a good PPI number for November. If that number comes in lower than what is expected, the market is going to take that in stride and it's going to go higher. If PPI is higher than what the market is expecting, the market is going to come down and anticipate the Fed's going to do more. Now, another thing that we need to pay attention to is also going to be the CPI, the CPI, the consumer price index, which is really what people are going to be watching. That data is going to be coming out on December 13th, one day before the FOMC meeting, the interest rate decision, and Federal Reserve Chairman Jerome Powell's decision on interest rates. Now, again, inflation, right? We need to see it coming down. If it's not coming down, that's not good. Interest rates are going to continue to be higher for longer. And so this is very, very interesting because all of these economic data points, okay, are going to be coming out right before the Fed meeting. The Fed meeting starts on the 13th and it's going to end on the 14th. So the Fed is going to be meeting together while they see the CPI data. Okay, the PPI data is going to be coming out a few days before that. The payroll number is going to be coming out a couple of weeks before that. And so it's going to be very, very important to see how is the Fed going to navigate this? Is this going to change anything that pretty much they've already decided to do? Me personally, this is what I believe. I believe that the Fed has probably already decided how they're going to raise interest rates in December. I believe they probably already decided if it's going to be a 0.5 or if it's going to be a 0.75. The Fed may change their mind on the fly, depending on these numbers, depending on non-farm payroll and unemployment, depending on producer price index, depending on CPI. But I believe that they probably already know what they want to do, and they may just have a little bit of confirmation based on these numbers. I think that these numbers are going to help them make decisions moving forward. That takes me to my next point. Next point, December 14th, the very next day after CPI, what do we have? We have the FOMC economic projections, FOMC statement, Fed interest rate decision, FOMC press conference. Now, notice what I have highlighted. I have the FOMC economic projections. What are we projecting? That's very, very important. The summary of economic projections is pretty much the Fed saying, hey, this is what has been going on in the economy. These are the interest rate decisions that we've been making. This is where we see the economy going. This is where we see inflation projected over a 12-month period. This is where we see the Fed's target rate projected over a period of time. This December 14th, this FOMC meeting is going to be very, very, very important in terms of deciding whether the market is going to come down closer to 3,500 at the end of this year, or if the market's going to close a little bit closer to 4,300 at the end of the year, because it's not necessarily about what the Fed's already done. We already know. It's about what are we projecting them to do moving forward, right? If the Fed tells us, hey, we expect the terminal rate to be between 4.5% to 5% and not much higher than that, and pretty much we get a little bit more clarity from Fed Chairman Jerome Powell, that may be good for the market. If the Fed is saying, hey, we need to be higher for longer, we get a 0.75% interest rate hike, and the Fed is telling us, hey, we may need to get to 6% or 7% on the terminal rate, that's not going to be good for the market at all. And so we've got to pay attention to those metrics to determine what we see. You need to pay attention to these things, right? Pay attention to all of them. Remember, let's go over these one more time. December 2nd, non-farm payroll and the unemployment rate. December 9th, PPI, producer price index. December 13th, consumer price index. FOMC meeting December 14th. Also, don't forget November 30th. I almost forgot. November 30th, Jerome Powell will be speaking. Pay attention to what he says 2 weeks prior before the meeting. Pay attention. This is going to be very, very important in terms of data points. Very, 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 very important in terms of our learning, right? In terms of us having more tools to the toolbox. He's going to make a statement on November 30th that's probably going to be different from the statement he makes on December 14th. Pay attention to what he says, how he answers the questions, because the data may shift him in one way or another. Because listen to this, the data that we need to see is going to come after this press conference. So make sure, write your notes down, pay attention to what he says on November 30th, cross-reference it to what he says on December 14th, especially understanding that the economic projections that we need to see will come after that particular meeting. Now, that's all I have right there in terms of economics. So we know the things that are going to move the market, right? Like we already know the things that are going to move the market. But now what we need to do is now we need to equate and assign these things that we know are going to move the market and associate them with potential prices. So now what I'm going to do is now I'm going to bring up Thinkorswim. Going to bring up Thinkorswim, bring up a chart. Now we're going to look at this chart. Okay, we're going to look at this chart, and we're going to, hold on real quick. My Thinkorswim went out. Give me 1 second, y'all, while I get Thinkorswim back together. I really like Thinkorswim. I really hope that you all consider, getting some Thinkorswim, because it's a very, very good platform, and I like how everything is laid out on it. So let me pull up Thinkorswim again. Hold on 1 second here. Please bear with me. Okay, getting everything set up here. Getting everything set up. I'm telling y'all this. I'm just gonna go ahead and tell you while I'm getting everything set up here. Like I said before, like I'm gonna say again. Like I said, we've been in a bear market. We've had a bad year. I'm telling you, y'all, we're gonna have some opportunities going into the end of this year to make some things happen. I promise you. Like I'm not trying to blow smoke at all. I'm really not trying to blow smoke. I'm trying to be real, and I'm trying to let you know that we're going to have some opportunity to take advantage of some moves that are going to be made in the market. The only thing that we have to do is make the preparations on the front end. Make the preparations on the front end, make your assessment from the data that we see, and then we can move forward. Okay, then we can definitely move forward. Okay, we got everything set up. Now let me share my screen. Let me share my screen. Okay, now we're good. Okay, now so this is a chart. So, if you've been following the Trade for Yourself podcast, we talk a lot about the S&P 500. And a lot of times I pull up SPY, because SPY is a reflection of the S&P 500. It's an ETF that tracks the movement of the S&P 500. Well, this chart right here is SPX, which is literally the S&P 500. And this is the S&P 500 over a 1 year time span, right? This is a 1 year time span, and we see that we are in a defined downtrend, okay? Now, last week, if you were able to watch the episode last week, please go back, watch the episode that I did on technical analysis. The only technical analysis class you will ever need. I promise you, it's the only one you're ever going to need. That's going to give you the introduction into the indicators that we're going to talk about today. So let's look at this chart, right? The first thing I want to look at is, notice that we are in a defined downtrend, right? We're in a defined downtrend, but at the same time, we're at some key levels. The first thing I want us to do is I want us to mark support. Okay, there's a key level of support that I want us to mark first, and this key level of support is right here at 4,000. Okay, it's right here at 4,000. And yesterday was the first time that the market closed above 4,000 since September. That was very, very big. Okay, that was very, very big that we saw the market close above 4,000. And like I said last week, in order for me to feel good about the market continuing to go higher, I need to see us close above 4,000. We closed above 4,000 yesterday, and we proceeded a little bit higher today. Now, right here, we see the market has been continuing to come down, and we're in a defined downtrend. Okay, a defined downtrend with a series of lower highs and lower lows. And so I want to draw this trend line, because trend lines can tell you a lot. And so let's draw this trend line all the way down here. Okay. Now, I pretty much drew a trend line from the beginning of January all the way to the end of this year. And as you can see, every single retrace up this year was pretty much stopped by this trend line. We were pretty much stopped at this trend line. And so this trend line is seen as resistance because we have been following this trend all year long. In order for me to feel good about something, I need to see the market go above this trend line, hold it in order for me to feel good about the market continuing to move higher. Now, you know, I want to get a little bit closer because I want to look at, okay, so, we look at this trend line, we've got this trend line drawn. Let's get a little bit closer. Let's look at how the market has been performing, let's say over the last 3 months. Okay, let's look at what has the market been doing over the last 3 months. And so remember, earlier in the month, we had that great CPI reading and the market proceeded up. We gapped up, moved higher. We've been doing some consolidation, and we finally closed above this 4,000 level. And that 4,000 level was very, very important. But I also want to look at some of these indicators that we have going on and see, okay, where are we really at right now in terms of the market? Okay. The first thing I want to add is I want to add in the 200-day moving average, right? The 200-day moving average is a very, very key moving average for us to think about. Now, the 200-day moving average, let's back out a little bit. And let's look at this 200-day moving average over a 1-year perspective. Now, as you can see, this 200-day moving average is in yellow. And in August, we had a great summer rally that peaked out right here at the 200-day moving average. Okay, now look at that. Now you could say this is a coincidence. You could say it's not. That 200-day moving average is right in line. It's like the crosshairs are right in line with that trend line. Okay, look at where we are right now. That 200-day moving average is right at 4,059.72. So call it 4,060, right? Which is a little bit higher than where we are right now, which is right near that trend line. Okay, so we're getting close to some key potential resistance. Okay, why do I think this is potential key resistance? Because let's look down here at the RSI. Remember, RSI, relative strength index. When you're above 70, you're beginning to get overbought. We may get overextended on the RSI because right now we're at 62. We're at 62 on the RSI. We're getting very, very close to 70. If we get a push to the 200-day moving average, and if we get another push to this trend line right here, we're probably going to get above 70 on the RSI, and we're going to get overextended. And so if that were to happen, that means in order for the market to continue to move higher, we're going to have to get a pullback, right? If we get to 4,100, we're gonna have to have a pullback to 4,000 as confirmation for us to say, hey, we want to keep moving higher. We can go to 4,100, pull back to 4,000, hold there, and then keep moving higher. But that's the thing though. We can say that the market may go higher, push this $4,100 trend line right here, and then come back down, which may actually be what it does, because we also see a gap right here. We also see a gap in price, and let me see if I can draw this gap. So a gap is what you would consider a dislocation in price, right? And so we've got a gap, and this gap happened, right here in September, and we had a gap, and we looked at and if we look at where we are approaching right here at the bottom of this gap. And so you could say that, man, we could go ahead and fill this gap back up to here, right in line with the bearish trend line, right near the 200-day moving average. These are all things that can happen. But once we get to these key levels, what is the market going to do? What's going to bring the market back down, right? So let's say November 30th, when Jerome Powell has his press conference, let's say he's extremely hawkish, right? and he's just talking, right? He's not making any decisions. He's just saying, hey, we're going to be very hawkish. Okay, let's say we go to the top of this gap. You know what I'm saying? We get right here at this trend line 4,100, and let's say we come down. You know, the current rally that we've been experiencing may stop right there because we're probably going to be overextended from an RSI perspective. So I'm telling everybody that we need to be careful right here because we're getting really close to some very, very key areas that we may reject. But if we reject those levels, come back and respect 4,000 and keep moving higher, what would have to happen economically for us to respect 4,000, right? The PPI index, the PPI number, that's going to have to be down. The consumer price index is going to have to be down. And the Fed is going to have to raise interest rates by 0.5%. And the Fed's going to have to give us very, very clear clarity in terms of the summary of economic projections. The Fed's going to have to tell us where we trying to get to. Okay, in terms of the Fed funds rate. If we can get some clarity on those three items right there, and the Fed gives us clarity in that finality, if we break above 4,100, above this trend line, hold that, I feel good about us possibly getting to 4,200. Feel good about us possibly getting to 4,300, as a lot of pundits have been saying on the TV. But I'm not going to feel good about that if we have bad economic data. So we have to pay attention to that. Pay attention. We are in a very, very key area right here, and we can go either way. And pretty much, what am I telling you? What am I telling you at the end of the day? A break and hold above 4,100. Like, if we can hold above 4,000, come to 4,100, break and hold above there, I feel good about us getting to 4,200 and possibly 4,300. If we get some bad economic data, a bad PPI number, a bad CPI number, where inflation is back invigorated again, and we close above this 3,900, this 3,900 is really, really key because this is a very, very key support level, okay? A break below that 3,900 level, combined with high inflation and the Fed being more aggressive than expected, that's what could get us to 3,800, 3,700, and closer to 35 and closer to 3,500. You know, because this is what I'm going to tell you. Let me mark one more level. And this level is 3,850. Okay, this level that I'm about to mark is going to be 3,850. Now, Devon, why do we care about 3,850, right? Why is 3,850 important? I'm going to tell you why. In about 3 seconds. Okay. Now, 3,850 is important because it's 20% below the 52-week highs. It's 20% below our all-time high. Remember what the definition of a bear market is. The definition of a bear market is 20% or lower, right? If we get bad economic data and we come back down and we close and we stay below 3,900, we're probably going to close below 3,850, which would put us into a bear year, right? A close below 3,850 would indicate that we would have a bear year, right? We haven't had a bear year in a while. It's been a while since we've had a bear year. And so that's why it's so important. That's why I'm watching this 3,900 level very, very closely, because even if we have, because that's what I'm saying too, we're getting close to being overextended at the end of the day. So we could still have some good economic data and still have to come back down and retest that 3,900, right? But if we come below that 3,900 level combined with the bad economic data, that's the thing. You've got to put these things together. We have to look at, okay, what are the economic projections? What's going on in the economy? And then we have to combine it and make an association with the price, because a lot of people will tell us that the charts will tell us a story. The charts will tell us a story about how people really truly feel about what's going on in the market. Okay, so, I've got some things drawn here. Again, what do I want to keep in mind? Okay, again, a break and hold above that 4,100 level, which coincides with right around the 200-day moving average and this bearish trend line. Okay, and a close above this gap. That's pretty much us getting above this gap in price, right? If we do that, that would make me feel bullish about us getting to 4,200 and possibly 4,300 combined with good economic data. That's what would make me feel good about getting to 4,200 and 4,300, like a lot of people are saying in the market, okay? And there's a possibility that can happen. But there's also a possibility that we could have some bad economic indicators and that we could close below 3,900 combined with high inflation and the Fed being way more aggressive than expected. That could get us down here below 3,850. And so those are levels I want you to mark. Those are levels that I want you to mark, okay? Remember, okay, one last thing. I want to add this. I forgot. One last thing I want to add. I want to add in the volume, because understanding the volume is going to be very important. Adding in this volume is very, very important. And I'm going to shift over to SPY so we can see the volume, right? I'm going to shift over to the ETF so we can see the volume, because I really want y'all to see this volume. Now let me get rid of all these lines, because all these lines are not necessary. Okay. Let me get a little closer. Last 3 months. Now, volume. The average volume on SPY has probably been over 90 million shares traded over the last 10 days. But we've been, over the last 3 days, we've had 51 million, 60 million, 68 million. Now, remember what I said previously. Remember, I was talking about, I really wanted us to close above that 400 level, and we did. We closed above it, right? We closed above 4,000 on SPX, and we're closing above 400 on SPY, and that's good. But remember, declining volume, right? Declining volume with an increase in price, that doesn't give me any conviction. Because most people in the market are not in the market right now. A lot of people are on vacation. Like I said before, the market is moving algorithmically right now. The institutions just set their prices, and they're going to move based on the news that happens, right? They're going to come back next week whenever decisions really start to be made. It's kind of like when you're a part of an organization. When you're a part of an organization and you meet, you have to have a quorum, right? And that quorum is pretty much, there has to be a certain amount of people that has to be at the meeting in order for business to be passed and for business to be transacted. Right now, we don't have a quorum in the market. We don't have 141 million shares traded. We don't have 128. We don't even have over 100 million shares traded. We're at 60 million shares traded. So I need more people to come back into the market to really truly tell me how they feel before I can make a decision on really truly what's going on. But when they come back, still remember 200-day moving average, remember RSI, remember November 30th Fed, remember 30th Jerome Powell, PPI, non-farm payroll, CPI, Fed meeting. All of these things combined together we're going to use all of these things in the toolbox combined together in order for us to make a determination on where we feel the market is going to be going. So again, I appreciate y'all again for tapping into another episode. Please make sure that you like this. Please like this. Okay, this is going to help me with my algorithm, help me get out to more people. Okay, keep in mind with these key metrics that I talked about, because I'm telling you, they're gonna help you make some money over the last 30 days of this year. I promise you. if you just do the research and just pay attention to what's going on over the next 30 days, I promise you, you will be rewarded if you just pay attention, follow the technicals, follow the price, go back and review the only technical analysis class that you will ever need, episode 44. And I promise you, you will be A-okay. And also continue to watch the Trade for Yourself podcast every single week to get the information that you need. As always, don't pay for it. Trade for it. Have a happy